Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Bo Eckstein.
Welcome to another episode of the Investor Financing Podcast, and I'm your host, Bo Eckstein, and today the episode's all about SBA 504 loan versus the SBA 7A loan. Okay, so let me tell you how the 504 is structured. There'd be a first lien position of 50% of the value of the property on an acquisition, let's say. So at 50% loan to value would be the bank loan. Then there's 40%, which is the guaranteed structure, and that's coming from a CDC. And the CDC will lend 40%, and then you as the borrower would come in for 10%. Now, SBA loans are geared for owner users. You can purchase existing buildings, land acquisition and ground up construction, including soft costs and developments, expansion of existing buildings, finance building improvements, purchase equipment. So those are like where you can use the proceeds for on a 504. Similar to SBA 7A, on a 7A you can expand, you can acquire or start a business, you can purchase or construct real estate, refinance existing business debt, buy equipment. Also, this could provide working capital, construct leasehold improvements, and or purchase inventory. So the requirements are that you have to occupy at least 51% of the building. And on new construction, they want to see 60% owner occupancy on that building. All assets financed must be used to the direct benefit of the business, okay? And then, so you could obviously not just finance real estate, you can finance business and equipment and things, but we're just talking about real estate on this episode. So why are you going to want to use a 504 versus a 7A? Well, 7A can go up to $5 million versus a 504 potentially you can do as a great a deal as like 20 million, okay? So that's a difference, right? So sometimes a 504 does make sense for that piece. I've structured deals like to build an assisted living facility where I was able to do a 7A, an SBA 7A, pari passu. So the SBA, and then there was also a conventional loan, and they were both in first lien. That's what pari passu is, basically. And I was able to do a total loan amount of about $11 million to build an assisted living facility. So there's ways to structure these deals. Now, the way a 504 differs is that you're going to have a first, which is a bank loan, and then you're going to have the CDC, and the CDC would be in second position, and the bank could be, the bank could have different terms in the second piece. So that's kind of the caveat of the two different kind of structures. So I prefer on something that's, smaller, that we definitely do an SBA 7A. Seems like a more streamlined process. On a 7A, fees can be financed. Fees vary with the size of the loan. Paired with the 504. Additionally, there's a quarter charge on any loan portion above $1 million. The banks kind of vary. Some banks are delegated where they can underwrite these SBA themselves. Some of them have to send them in for approval if they're non-delegated. But really kind of what I want to stress upon on this episode is that, like, how powerful SBA is for you. Let's just say you wanted to buy a building for your business. Your business could be anything, and you could potentially get an SBA loan to buy that building, and you can get 90% loan to cost. I mean, you're not going to find higher leverage, loan out there. So owner user could be a self-storage facility you're buying or building. It could be assisted living facility. It could be a gas station you're buying. It could be any kind of business really that's considered an owner-occupied business. There's certain businesses like you can't buy a multifamily property with an SBA loan, but really, SBA is a great tool for owner users, and you can buy real estate, you can buy businesses, you can buy franchises. There's so much you can do with these. And right now, during COVID times, right, people are really, really utilizing SBA.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
So going back to it all, kind of wrapping it up here, why you would want to do an SBA loan. You'd want to do an SBA loan for many reasons, because one is the leverage is the highest out there in the industry. The pricing's fairly good. There's some SBA guarantee fees that you have to pay up front at close of escrow, but you can finance those fees. They're financeable. And really, if you're building something from scratch, you can get higher leverage, where you can get 90% leverage versus maybe 65 from a bank. So SBA is powerful for construction, very powerful for, if you're building your own office building, if you're, building a self-storage facility, if you're building assisted living. SBA can finance hotels, although right now it's a little bit more challenging. So if you're building a hotel or you're refinancing a hotel, a 504 or a 7A could be a great resource. There's so many valuable reasons to use SBA. And then the 7A is similar in a way to the USDA B&I loan. So if you're in a more rural area, sometimes the USDA B&I loan is good for buying certain businesses or refinancing business debts, similar to the 7A. And so sometimes it does make more sense to go USDA versus 7A, because USDA can do loans as great as $25 million. So there's USDA is really kind of to stimulate growth in smaller communities of 50,000 or less in population. We have a map that we use, and we can quickly put in an address and see if it's in an eligible area for USDA. So there's all these government insured programs that are there for you to learn about, to take advantage of, and to finance your business or finance your building, your office building, to grow wealth using this funding source out there, because there's a lot of reasons to use it. And like I said, SBA is funding a ton of franchise acquisitions. So if you want to buy a franchise, some of them are already pre-approved, so it streamlines the process on buying certain businesses. They usually we want to see, if you're buying an existing building, or existing business, we're going to want to see 3 years of tax returns from that business, and they want to see a year-to-date profit and loss statement. They're going to dig deep. They want to see a business that is, cash flowing right now. So that's the one thing you got to really look at. If you're buying an existing business, it's got to be producing positive cash flow. It's got to be able to debt service coverage, right? And that's the thing. So SBA is going to require copies of the business's tax returns and so forth. But going back to the construction of building something from the ground up, you can finance land acquisition, soft costs. You can finance pretty much everything. So SBA really, really is a great tool. And I encourage you, if you have any questions, to reach out. The way I work is I work with several of the top SBA lenders out there, and each bank or non-bank SBA lender, because there are non-bank SBAs lenders out there, they have different appetites about what they will fund. Like some will fund assisted living, and some don't do ground up construction. Some just do business acquisition. So what we do is we just get in touch, and we know who's got appetites for what. If we're doing construction, we have certain lenders that do construction loans for SBA, because the SBA piece actually comes in after you get certificate of occupancy. So actually it's kind of like a bridge loan first, or bridge or construction loan. Once we get certificate of occupancy, then we can take it out with the 504. Or the 7A is different, but the 504 actually comes into play after we get certificate of occupancy. So if you have any scenarios or anything, feel free to reach out to us. Happy to talk to you about SBA and figure out if it's a viable project for SBA. But thanks for listening to this episode. I hope it was informative, and please share and like this podcast. We're on YouTube. You can go to investorfinancingpodcast.com and watch all the previous episodes. You can find us on iTunes, Stitcher, all those podcast platforms. Have a great day, and thanks for listening.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.